Overview of financial statement analysis. Financial statement analysis, or FSA, is a cornerstone of financial management and investment decision-making, offering vital insights into a company's financial health, performance, and prospects. At its core, FSA is a systematic review of quantitative and qualitative information found in financial statements and supplementary disclosures, including the balance sheet, income statement, cash flow statement, and the notes, to assess profitability, liquidity, solvency, and value creation. This analytical process empowers stakeholders, including investors, creditors, managers, and analysts, to make informed investment, lending, strategic planning, and risk management decisions. FSA is the process of assessing and interpreting financial statements to evaluate a company's performance, profitability, solvency, and liquidity. It involves a systematic review of quantitative and qualitative information in financial statements and supplementary disclosures to understand an organization's financial standing better. By analyzing financial statements, stakeholders can make informed decisions regarding investment opportunities, creditworthiness, and overall business prospects. FSA has 4 objectives. The first objective is assessing financial performance. The primary objective of FSA is to evaluate a company's financial performance over a specific period. By analyzing key financial ratios, such as profitability ratios like gross profit margin and net profit margin, efficiency ratios like asset turnover and inventory turnover, and return ratios like return on assets and return on equity, stakeholders can gauge how effectively a company is utilizing its resources and generating profits. The second objective is evaluating financial position through its liquidity and solvency. By examining liquidity ratios like the current ratio and quick ratio, and solvency ratios like the debt-to-equity ratio and interest coverage ratio, stakeholders can determine a company's ability to meet its short-term obligations and long-term financial stability. The third objective, identifying trends and patterns. FSA enables stakeholders to identify trends and patterns in a company's financial performance. Analysts can identify growth patterns, cyclical fluctuations, and potential areas of improvement or concern by comparing financial statements over multiple periods. And the fourth objective consists in assessing management efficiency in utilizing company resources. Analysts can determine how efficiently a company is managing its assets and generating revenue by examining financial ratios related to asset management, such as inventory turnover and receivables turnover. We use various tools to conduct a financial statements analysis. This first one is horizontal analysis. This involves the comparison of financial statements across multiple periods to identify trends and changes in financial performance. Horizontal analysis helps stakeholders understand how a company's financials have evolved. The second tool is vertical analysis. It is also known as common size analysis. It involves expressing financial statement items as a percentage of a base amount. It helps stakeholders assess the relative importance of different components within the financial statements and identify potential areas of concern or improvement. The third is ratio analysis. It is a fundamental component of financial statement analysis. It involves calculating and interpreting various financial ratios to assess a company's performance, profitability, liquidity, and solvency. Ratio analysis provides meaningful insights by comparing financial statement items relative to each other. The fourth is comparative analysis, which involves benchmarking a company's financial performance against industry peers, competitors, or established standards. This comparison helps stakeholders understand how a company fares with its counterparts and identify areas of strength or weakness. Financial statement analysis serves diverse users, including stockholders, creditors, management, analysts, regulatory authorities, and other stakeholders. It provides valuable insights into a company's financial health and performance. Stockholders analyze financial statements to assess the company's financial health and performance before making investment decisions. They examine profitability, growth potential, and risk factors to determine whether to buy, hold, or sell securities. Creditors, such as banks and bondholders, use FSA to evaluate the creditworthiness of companies seeking loans or issuing debt securities. They assess the company's ability to repay debt obligations by analyzing liquidity, solvency, and cash flow metrics. Management. The company executives and managers utilize financial statement analysis to monitor financial performance, identify areas for improvement, and make strategic decisions. Financial analysis helps management set financial goals, allocate resources effectively, and track progress in achieving objectives. Financial analysts employed by investment firms, brokerage houses, and research organizations rely on financial statement analysis to provide investment recommendations, valuation estimates, and market insights to clients. They conduct in-depth analyses of financial statements to uncover investment opportunities and assess industry trends. Regulators and government agencies, they use financial statement analysis to monitor compliance with financial reporting standards, detect fraudulent activities, and ensure transparency and accountability in financial markets. They may also rely on financial statement analysis to assess the overall stability and integrity of the financial system. Other stakeholders. Financial statement analysis is also valuable to other stakeholders, such as suppliers, customers, employees, and competitors. They may use financial information to evaluate business relationships, assess credit risk, negotiate contracts, or benchmark performance against industry peers. In summary, financial statement analysis is a critical process that evaluates a company's performance, profitability, solvency, and liquidity through a systematic review of its financial statements and supplementary disclosures. It aims to assess financial performance, evaluate financial position, identify trends and patterns, and appraise management efficiency, enabling informed decisions about investment, creditworthiness, and business prospects. Quiz. Welcome to the Overview of Financial Analysis quiz. This quiz will test your knowledge. Please select the correct answer for each question.